Real estate is one of the most powerful way to build wealth. And do you know that what makes it even more powerful? Leverage. When used correctly, leveraging debt can multiply your returns, allow you scale faster and significantly increase your purchasing power. But there's a right way and a wrong way to do it. And today, I'm breaking down how to leverage debt wisely, especially if you're investing in commercial real estate. So let's get into it. If you are new to my channel, my name is Jazz O'Brien and I'm a real estate agent, investor and a serial entrepreneur. I went from working as a server to owning multi-million dollar worth of real estate portfolio in just 8 years. In my career, I have helped hundreds of my clients buy over 900 million worth of real estate using tried and tested strategies, and I am here to share those tips with you on this channel. Before we dive, let me be very clear. I'm not a financial advisor or a mortgage broker. This is based on my experience as a real estate investor, and this video is only for educational purposes. Everyone's financial situation is different, so always consult a qualified professional before making investment decisions. Understanding leverage in commercial real estate. First, what exactly is leverage? Leverage in real estate means using borrowed money, usually from mortgage, to buy a property. Instead of paying the full price in cash, you put down a fraction of the cost, your down payment, and then bank covers the rest. Why is leverage so powerful? Because it allows you to control much larger asset with relatively small amount of your own money. And as the property appreciates, your returns are magnified. The key metric investors ignore. Most investors focus on cash flow, but even more important metric is return on equity or ROE. ROE measures how efficiently your initial down payment is working for you. Example, let's say you buy a $5 million commercial plaza with a $1 million down payment. Over the time, the property appreciates and the tenants pay down the mortgage and your equity increases. If the property appreciates to $6 million, your equity has grown from $1 million to $2 million. That means your original investment has doubled in value. The power of refinancing. Here's where smart investors take it further, by refinancing. When your property appreciates and you have built up an equity, you can refinance by taking out a new mortgage at a higher property value. How does refinancing work? If your property is now worth $6 million and the banks allow you to refinance up to 75% of it, you could pull out hundreds of thousands of dollars or even millions of dollars without selling the property. You're not cashing out, you're recycling your equity and using it to acquire more properties. This is how commercial real estate investors scale. Costs and considerations when refinancing. Refinancing isn't free. What should you consider? While pulling out equity is a great way to reinvest, you need to account for refinancing fees, legal costs, potential payment penalties depending on your existing mortgage. If you're going to be closing your mortgage sooner than it's supposed to be, there could be a penalty. Main thing matters is the interest rates. If interest rates have dropped since your original mortgage, refinancing can actually lower your overall borrowing costs. But if the rates have risen, you need to make sure new loan terms still align with your investment goals. Leveraging that in high value commercial market. In a high value market like BC, where commercial properties such as strip malls and plazas are in a high demand, leverage becomes even more important. Most investors don't pay for properties in full. They use financing strategically to grow. Key factors to consider: cash flow versus appreciation. Unlike residential properties, commercial real estate often offers strong cash flow. The goal is to ensure your rental income covers financing costs while benefiting from long-term appreciation. Tenant strength and lease terms. Long-term tenant leases with reliable tenants can stabilize cash flow and make financing easier. Banks prefer properties with strong established tenants, like a AAA tenants, like banks, Starbucks, Tim Hortons, any national tenants. Banks always love to give you the mortgage on it. Market trends and vacancy rates. Understanding the commercial market trends ensure that your leverage investments continue to perform and appreciate in value. Avoid leverage and managing risk. Leverage is powerful, but it also increases risk. If the market dips or interest rates rise, highly leveraged investors may struggle with increased mortgage payments. How to protect yourself? Have a financial cushion. Cash reserves or access of a line of credit can save you in tough times. Ensure positive cash flow properties. Even in a high cost market, running numbers conservatively ensures you can cover expenses. Work with experienced mortgage brokers. Lender look at debt to income ratio, rental income, and credit history when assessing your eligibility for future financing. Having the right mortgage strategy is crucial. Shifting your mindset to debt. A lot of people fear debt, and I completely understand. But in commercial real estate, debt, when used correctly, is a tool for growth. The wealthiest investors use debt wisely. They buy assets that produce income. Smart investors use debt to acquire appreciating assets. They reinvest strategically. Instead of paying off properties too quickly, they keep reinvesting to scale. They leverage opportunities that align with their financial goals. Every decision is made with the long-term wealth in mind. If you're serious about building wealth through commercial real estate, leveraging debt effectively can be one of your greatest advantages. But you need to do it with a clear strategy, the right financial partners, and a solid understanding of your numbers. If you got a value from this, make sure to like and subscribe for more real estate insights. And if you want to discuss your commercial real estate strategy, book a coffee session with me using the link in the description. Let's talk about how you can grow your portfolio the smart way. Until then, see you next time. Take care.